Hi, everyone, and welcome to the Barron Discovery First Quarter 2023 Quarterly Review for the fund. I'm Randy Gwirtzman, and I'm here with my partner, Laird Bieger. Quick review of first quarter performance. The fund was up just over 11%, which was about 5% ahead of the index. We also have what we view as very good 3-year, 5-year, and since inception performance. On a 3-year basis, the fund is up 16% annualized, which is about 3% ahead of the index. On a 5-year basis, we're up about 10%, which is 5% ahead of the index. And since inception, we've annualized about 12%, which is about 5% ahead of the index. So we're pretty happy with the performance. And I'm going to leave it to Laird to go through a couple of the key things that we're thinking about go forward right now.
Hello, everyone. How are you? We are changing the format a little bit this time, and we're thinking in terms of giving you very focused takeaways that we wanted you to have coming out of this quarter. So we are calling it our top 3 takeaways that we want all investors to know. So let's go right into it. Takeaway number 1 that we're going to focus on, we're calling our fat pitch, using the baseball analogy. Takeaway number 2, we're calling crosscurrents. And takeaway number 3, we're calling economic recovery. So let's talk about takeaway number 1, fat pitch. For those that don't know, the baseball analogy is instead of looking for that ball that is either too high or outside, inside, you wait as a batter with discipline until you can get that pitch that's squarely in the strike zone. And so thinking back to the third quarter of 2022, one of the comments that we had made in that quarterly letter was the fact that the setup was as good as we'd seen since the great GFC, Great Financial Crisis, and before that, the early 2000s. And what we meant by that at the time, and we talked about this in the letter with some corresponding charts, was the fact that sentiment was very negative. And was actually at an all-time high. If you were to go back and look at the AAII survey, it had never been, and then you're looking at September of 2022, it had never been that bearish at all time, and that goes back to the early 80s. So you had very negative sentiment, and that was combined with what we felt like were very attractive valuations, both relative to large cap. It was small caps were trading at a discount to large cap, which hadn't happened in over 20 years. And in addition, just on an absolute basis, we felt that valuations look very good. And so, we talk about this fat pitch element, and today, as we sit here, one of the things we want to say is that even though we're now 6 months later, and obviously the benchmark has been up for the last 2 quarters, we still feel like the asset class is at a very attractive opportunity. It's early days. And while sentiment isn't as negative as it was back in September, it's still, historically negative, and valuations to us look very attractive for medium to long-term investors. Number 2, crosscurrents. Takeaway number 2. One of the things I wanted to try to point out was the changes that we've seen since we made that call back in October. And one of the biggest ones, of course, is that we had the Silicon Valley Bank and also the other couple of banks that went into liquidation. So we had this banking crisis, which we believe is going to lead to tighter credit conditions, which is a negative. However, that's offset by what we're seeing as significant improvements in things such as supply chains, input cost pressures, labor availability, and labor inflation. And we're also seeing companies initiate what are really tight expense controls, seeing that this environment is what it is. And it's our belief that the street is probably underestimating the positive impact that we're going to see as a result of all those on margins. And so while we're taking a more conservative approach to overall demand as a result of tighter credit conditions, we're also much more constructive than I think the rest of Wall Street as it pertains to margin opportunities. Despite that, are more conservative view on top line growth for this year. So takeaway number 3, we're calling the economic recovery. I was once having a conversation with an investor, and they made a very both funny and interesting point, which was it was during a period where I was pretty bearish on what was going on, and this particular investor said to me, Laird, don't forget that 100% of economic downturns are followed by economic recoveries, which I thought was both a true, obviously, statement, but also something that you need to keep in mind, which is if you were to turn on CNBC today, obviously investors tend to be very bearish. We're hearing a lot of bad news that is out there, but we also have to keep perspective because there will come a day where investors are going to change their focus from how bad is this economic downturn to what could the next economic recovery look like. And we've seen when this happens that fundamentals may continue to be getting worse. However, valuation multiples will start to expand in the face of even deteriorating fundamentals. The market will anticipate a recovery before it actually starts to happen, typically 6 to 9 months. And so one of the things that we think investors need to realize is that as we move through 2023, investors are going to start changing their focus and thinking about what a 2024 recovery could look like.
And I just, a couple of points to emphasize what Laird's saying in terms of the portfolio positioning go forward, in terms of how we relate to these beliefs, the fat pitch, and that will benefit during a recovery. The portfolio now is about 46% in the high growth bucket, as we call it. We have 3 different growth buckets. And so we're tilting a little bit more towards growth. But the overall quality of the companies has actually increased pretty well over the last couple of years. And so just a couple of examples of that. We are much lower on a debt to cap ratio and other debt metrics versus other stocks in the index. And only 16% of the assets in the portfolio are invested in companies that have negative cash flow. All those negative cash flow companies, we believe, are funded through break even. And the rest are, the majority of the rest are actually cash flow positive with some cash flow neutrals as well. So we're pretty excited that coming out of this current period, we think we're positioned well with high quality companies that still have tremendous growth prospects. And what Laird and I would like to do is to just talk a little bit about a couple of the new companies that we've put into the portfolio. And you can read more about it in the quarterly letter as you can about all the other aspects of the quarter. Let's start with a company called SiTime. The ticker is SITM. SiTime is a $2.6 billion market cap analog semiconductor company that is fabless, meaning that they do the design, but they outsource the actual manufacturing. And this leads to very high margins. So right now the company is in the 60% gross margin. We think that goes to 65% over time. Right now, revenues of the company are about $200 million, and we believe that that's going to grow to $600 million over time. And the company has a very good amount of cash on its balance sheet. Now, what they do is they manufacture, or they design for manufacture MEMS chips that are used for timing. And MEMS is a mechanical electronic system. It literally is a kind of a functioning mechanical printed chip as opposed to pure circuitry, which makes it a lot harder for other people to be able to do and to be able to do well. They have extremely high 90 to 95% yields, which obviously is part of what leads to higher margins. And these chips have taken a very good amount of market share in timing. What they're used for is to time circuits on a motherboard to make sure everything synchronizes, and for end applications in communications, in aerospace and defense, and other areas like data center, where synchronization of internal components or communication between multiple components is critical, and you need perfect timing. So why use a MEMS instead of what the standard used to be, which was quartz, which has been around for 50, 60 years? Quartz is, you may have an old watch that has a quartz chip in it, and they resonate at a very particular frequency, and that makes the timing accurate. However, it's set to that frequency because it's a physical property of the crystal itself, and they function differently in different environments, whether it's a stress environment such as extreme vibration that you might have on an airframe, or in a high temperature situation. So using MEMS allows you to adjust for those parameters and also to actually program the chip for different environments and dynamic parameters that you want to change. They're the market leader with 80 to 90% share, and they've been doing an extremely good job of expanding the market, which is now about $1 billion. We believe growing to $4 billion over the next few years, and in 10 years it could be a $10 billion served market. We believe that the company could potentially get up to $2 billion in revenues over that time period, and if we had 30% cash flow margins, you'd have $600 million in cash flow, which would be worth, you know, 12 billion plus maybe $15 billion enterprise value versus a company that's $2 billion enterprise value now. We're pretty excited about it. We think that over the next 5 years, we have the ability to grow earnings from the $2 range to the $8 range, and that should lead to at least a double in the valuation of the stock. Laird, do you want to talk about the next idea?
Sure. So I'm going to talk about a new addition in the portfolio, DraftKings. DraftKings is a former holding. For those that have been investors in the strategy for a few years, you'll remember that we first purchased DraftKings back in the dark days of the pandemic. We held that until it got to a valuation that we felt represented the upside, future upside. Since then, the company's stock has come back down, and during the quarter, we reinvested it. So to give you a little reminder on our view, we've been very bullish on online sports betting and iCasino broadly. This is an area that from today, we think is going to triple even over the next 5 to 7 years, just from a macro perspective. And then from a more micro perspective, we've had exposure to the leader, the market share leader, which is FanDuel, through our ownership of Boyd Gaming, which is the second largest, I believe, holding in the portfolio today. And so Boyd owns a 5% position within of FanDuel. So we've always had that exposure. But we did think it was appropriate to also purchase DraftKings this quarter. DraftKings is the number 2 player within OSB and iCasino. And as I mentioned, it's a market that we think is going to triple over the next 5 to 7 years. It's a business where there's true barriers to entry. While they're the number 2 player after FanDuel, we also think that they have a lot of momentum with product development and a broader array of bet types, which is really differentiating them from the other players that are in the market. They have a first mover advantage when they go into new states. We've talked about this in the past, but because FanDuel and DraftKings have fantasy sports, daily fantasy sports as part of their offering, they've been in these states first. And so they own these customers already. So it's much easier for them to get share when a new state launches. We believe this first mover advantage is going to allow them to maintain their number 2 market share go forward. And we also think it's very important that they have this flywheel effect of superior product, brand, and scale that creates a sustainable barrier to entry that we think other competitors are going to have a difficult time cracking. Just as an example, I had gone back and looked and just seen they spent $4 billion in R&D and marketing, over the last few years, getting to the point where we are today. So significant dollars that would be very difficult for a new competitor to replicate. One of the key things that we saw and one of the biggest changes in the first quarter was management and focusing on their cost structure and their drive to achieve profitability in calendar 2024. This is something that I think that they really focused on and was maybe not as much as a focus, or was at least there was a concern there wasn't. And so this was a big change and something we felt was a huge positive, and one of the reasons that we were attracted again to DraftKings in the first place. Over the next 5 years, we think the company can generate about $6 billion in revenue 5 years out, which is about a 20% CAGR. And at that level of revenue, they should generate around $1 billion of EBITDA. Using the mid to upper teens multiple, we think the stock is worth in the low 40s, so more than a double from current levels. And we actually bought at levels below where it's trading today.
So with that, I think we'll wrap up the webcast. Hope you enjoyed the content, and please look for our quarterly letter at www.baronfunds.com, and we will catch up with you soon. Thanks for your interest in the fund.
Thank you.